There is a famous geopolitical maxim. There are decades when nothing happens, and there are weeks where decades happen. We are currently navigating one of those transformative weeks. The protracted conflict in the Middle East has finally triggered a seismic shift that many analysts thought impossible. The United Arab Emirates, UAE, is officially decoupling from the OPEC oil cartel. This is not merely a diplomatic headline. It is a radical shift in the global energy order. For the average consumer and investor, this move signals a transition toward extreme market volatility, shifting energy prices, and the potential collapse of the collective security that has governed oil for over 60 years. The great cartel crack-up, OPEC versus OPEC+. To grasp the magnitude of this exit, one must understand the two-tier structure of global oil governance that the UAE is abandoning. OPEC. Established in 1960, this core group of 12 member nations, including Saudi Arabia, Iraq, and Nigeria, has long been the primary engine of price control. Led by Saudi Arabia, it holds approximately 80% of the world's oil reserves and commands a 30 to 40% market share. OPEC+, a more recent, broader coalition that includes the original 12 plus non-OPEC heavyweights like Russia, Mexico, and Kazakhstan. This group, collared by Saudi Arabia and Russia, controls nearly 90% of reserves and roughly half of the global market. The cartel operates on a simple, ruthless economic principle: control the supply to dictate the price. By artificially restricting production, they ensure capital accumulation and high revenues for member states. A historical day, shaking the world. The UAE's departure represents a fundamental fracture in this system. When a founding-tier member chooses unilateralism over collective bargaining, the very foundation of global oil price stability begins to crumble. Financial survival and the broken security umbrella, the UAE's strategic divergence from Saudi Arabia, is born of necessity, not just policy. Unlike Saudi Arabia, which remains almost singularly dependent on oil exports, the UAE has spent decades building a diversified economy centered on tourism and real estate. However, the Middle East conflict has shattered the illusion of stability required for these sectors to thrive. The UAE has faced repeated regional attacks and, crucially, feels undefended by its neighbors. The lack of a serious counteroffensive against Iran following these provocations has convinced the UAE that the regional security umbrella is non-existent. With its tourism and real estate sectors facing a crisis that could take decades to repair, and marketing efforts currently desperate to sell a future that feels increasingly precarious, the UAE has adopted a UAE-first policy. They are prioritizing immediate sovereign survival over group solidarity with a cartel that no longer provides security or economic alignment. Shattering the production, sealing the core of the UAE's new strategy is the rejection of the restricted quota. Under OPEC rules, the UAE was forced to produce well below its true capacity to keep global prices high. While the cartel might have restricted them to a fraction of their potential, the UAE is now moving toward its full production capacity of several million barrels per day. The economic logic of this decoupling is straightforward: maximize liquidity. By ignoring the 100 to 200,000 barrel per day restrictions previously imposed by the cartel, the UAE can flood the market with its own supply. Monetize demand. In a market where conflict has already pushed prices higher, the UAE aims to sell maximum volume at these elevated rates to build a massive cash reserve. Unilateral production. The UAE will no longer wait for a consensus in Riyadh or Moscow to decide how much of its own resource it can sell. Strategic liquidation. Funding the silicon future, the UAE is viewing the oil game with cold-blooded skepticism. They recognize that fossil fuel dominance is a sunset industry, and the current regional instability has accelerated the timeline for its decline. The UAE views their current oil reserves as a burning asset, one that must be liquidated now before the regional damage becomes irreversible. The goal is to generate massive liquidity reserves to fund an aggressive pivot into the next industrial revolution. The UAE is aggressively reinvesting oil profits into artificial intelligence, AI, infrastructure, semiconductor chip manufacturing. By liquidating their fossil fuel assets today, they are attempting to buy their way into a digital safe haven, ensuring their economic relevance in a post-oil, high-tech future. The India impact, short-term volatility, long-term strategic play for India, the world's third-largest oil consumer. The UAE's exit is a double-edged sword, short-term inflationary shock. The sheer uncertainty of the UAE's exit has sent crude prices surging past $110 per barrel. If the market continues to shake, India faces significant inflationary pressure on petrol and diesel, which could hinder domestic economic growth. Long-term strategic opportunity. The UAE's independence allows for direct, bilateral energy security deals. The recent high-level visit by India's National Security Advisor, NSA, to the UAE suggests that New Delhi is already moving to secure a direct supply line. Without the middlemen of the Saudi-led cartel, India and the UAE can negotiate terms that provide India with a stable supplier and the UAE with a guaranteed massive market. The rise of energy unilateralism. The UAE's exit from OPEC marks the end of an era of collective energy governance. We have entered an age of energy unilateralism, where the every nation for itself mentality replaces the old cartelist order. The Middle East war has acted as a catalyst, forcing the UAE to choose between a failing regional alliance and its own technological survival. The era of cartel-controlled energy is dying. In its place, we are seeing the rise of a more volatile, competitive, and unpredictable market where oil is no longer a long-term treasure, but a commodity to be sold off as quickly as possible to fund the silicon future. The question is no longer when the oil era will end, but who will be the first to successfully escape it.